Hello, everyone. My name is Sid, and I'm the President of the CFA Society Ottawa. Thank you all for joining us today. It's great to see such a good turnout right ahead of the holiday season. So as you know, today's webinar is titled Reinventing Stock Picking with Advanced Research and Decision Analytics. So I'm very excited to introduce you to Chris Horwood and Eric Murray from Orbis, who will cover the topic with a Q&A fireside chat type of approach. And with Eric doing the majority of the presentation with some time towards the end as well. But as they'll be doing and providing a bit of an introduction themselves, I'll just hand over the mic to Chris and Eric now and allow them to get right into the presentation. But as always, please feel free to post your questions using the Q&A function, and they'll aim to address as many as possible toward the end of the presentation. So with that said, Eric and Chris, it's all yours. Thank you again.
Great. Good afternoon, everyone, and thank you, Sid, for that introduction. My name is Chris Horwood, and I lead the institutional client business in Canada for Orbis Investments, a contrarian investment firm founded in 1989 and specializing in bottom-up stock picking in global markets. I'll be moderating the Q&A following the presentation and was asked to kick things off with a brief intro. As Sid mentioned, our presentation is entitled Reinventing Stock Picking with Advanced Research and Decision Analytics. Now, this is intentionally a bit of a sensational title. In fact, it was a play on the theme of a conference when we first spoke on this topic. But I think it's pretty clear that the tools which asset managers use today are evolving rapidly with technology and the availability of new data. And this really is changing the way we invest. So if you spend at least part of your time trying to understand and assess asset managers, or perhaps you're an investor yourself, it's critical to try and stay on top of these developments. My colleague Eric Murray spent the last 7 years researching US stocks at Orbis and is uniquely placed to provide a practitioner's perspective on this subject. Specifically, Eric will use some examples from Orbis to illustrate some of the new and innovative ways that asset managers generally are leveraging technology and data, even within a traditional stock picking process, doing so to make better decisions about both stocks and their people. Now, before passing over to Eric, just a final reminder, as Sid mentioned, that we will have some time, probably at least 15 minutes set aside for questions at the end of the presentation. So please do submit some questions as we go, and we'll make sure to get to them at the end of the presentation. With that, over to you, Eric.
Thanks, Chris. Thanks for the intro. We all have one thing in common, right? We're trying to add value through investment decisions, whether you're a manager or an allocator or asset owner, whatever it might be. And many of us are grappling with the risks and opportunities brought on by technology. As Chris mentioned, at Orbis, we're not quant managers. We're fundamental bottom-up investors, but the use of technology isn't binary anymore. And we recognize that even fundamental managers like us need to adapt to keep up with that pace of change. So while we're not quant managers, and quant certainly isn't my area of expertise, we recognize that as bottom-up stock pickers, we need to integrate technology in creative ways to help improve our decision-making while remaining true to our fundamental long-term and contrarian investment approach. So that's what I hope to offer you today, a fundamental stock picker's perspective on technology in both the research process and in investment decision-making. So we've structured the talk as follows. So first, I'll lay just a little bit of groundwork to understand what's changed. Second, we'll talk about how leading edge technology is being applied in investment research. Third, and this is, I think, the really exciting bit, we'll cover some applications of what we've labeled decision analytics, which is really all about improved decision-making. And then lastly, we'll conclude with a couple of points that you might incorporate in how you approach investing and perhaps in manager meetings as well. So let's dive in. I think it's important to remember that investment analysis has never been static. So it's always been evolving to make use of the latest technology. But until the 1980s, there wasn't much. And here's, I think, a fun illustration of it. So this shows our founder, Alan Gray, keeping track of quarterly earnings for JP Morgan by hand in a table. And those figures were kept in a binder like this on the left-hand side. And I think like many other value investors, he always had the latest value line sheet nearby, which you can see on the right. And that manual approach really started to change in earnest, at least for us in the 1990s. So here's the actual order for Orbis's first corporate computer. And we might have been late to the game, but this order was placed in July 1990, which is a year after our founding, and just as the growth in Bloomberg terminals was really starting to pick up. Our order for this Intel 386-based computer cost us over £6,000 at the time. That's kind of funny to think about, given that that iPhone that's probably in your pocket or maybe on your desk is tens or hundreds of thousands of times more powerful. So the computing power that's applied to investing has come quite a long way. And the other thing, of course, that's changed is just the amount of data out there that we could incorporate. So I recently saw a stat that said 90% of all recorded data was generated in the last 2 years. And I don't know if that's true or not, but there's no doubt that there is just more data than ever to work with. Now, not much of that is useful for investment analysis, but some of it might be. And if we want to stay competitive, we need to at least explore what could be useful. So from a stock picker's perspective, the question then becomes, how do you identify what's useful? And how do you incorporate that in your investment process? And at least I think of that as not a trivial task, right? So identifying that useful data, collecting it, processing it at a large volume is a very different skill set from what you might expect a lot of stock pickers to have, like analyzing competitive positions, that sort of thing. It's quite different from your day-to-day. If things have come so far, you might even be tempted to think it's time to let the machines take over and let algorithms dominate even our style of investing, fundamental bottom-up investing. And some firms have done just that, so handing over control to AI algorithms that put portfolios together for them. But for us, as a firm specializing in bottom-up stock picking based on fundamentals with a long time horizon, that's not how we see the world. We think that there could be a better analogy in chess. And if this sparks an interest, make sure you check out The Queen's Gambit on Netflix, because it's a great show. But The Queen's Gambit, that really covers the 1960s and 1970s world of chess. And chess didn't change much for another 30 or 40 years from that point. But chess is being a very complex game, it still has a fixed rule set. And because of that, you might expect it to be a game that gets solved by computers. And indeed it was in 1997, when IBM's Deep Blue beat the greatest chess player of all time, Garry Kasparov. And after this match, Garry quickly became an advocate for using computers in practice. And he eventually helped develop a new format called freestyle chess, where teams of players with access to computers would compete against each other. Now, freestyle chess is a little bit like an open book exam, right? It might sound easier because you've got access to your computer, you've got access to a lot of data, but of course your opponents have the same advantage. And so what happened there really is it elevated the level of play. And so with each step here, the quality of play improved. So those human machine hybrids or cyborgs can beat just the machines alone. And of course, the machines alone can quite easily beat humans at this point. Now, if you take a step back from that, to me, that's very surprising because humans are biased. So we struggle to think rationally. And in his famous speech, The Psychology of Human Misjudgment, Charlie Munger covered 25 different biases that affect our decision-making. And that's far from a complete list. So how do humans actually add value in freestyle chess? It turns out, thankfully, that we are more creative than machines. And when we are armed with them, we can learn how to use their strengths to complement our own and to offset our own weaknesses. So if we work with them, we can play much better than the machines alone. And that gets to the gist of what we're talking about today. So it's all about incorporating technology and data in your decision-making as a way to retain or enhance your investing edge. But unlike chess, there's no well-defined rule set in investing, right? So it's a lot more complex, and it remains a lot more art than science. But we do think this topic is important for every manager, and that includes investors like us with a fundamental long-term strategy. And we're excited about the applications here in two areas. The first we've called advanced research. That's really everything that happens before an investment decision is made. We think this is a little bit more developed and a bit more straightforward. The second part is a little bit more experimental. We've called this decision analytics, and this is really all about how you can help make better investment decisions. There is a bit of a dual purpose there, so it's a learning tool for decision makers, but it's also potentially a way for those responsible for assessing those decision makers to try to tease out skill from luck and ensure you're rewarding and promoting those who show the most promise. So like I mentioned, this part's a little bit more experimental, but we think it's more differentiated and more promising. But please keep in mind our own work here is at an earlier stage as well. So let's dive into that first area, advanced research. As a stock picker, researching stock ideas is how you spend most of your time. And you might spend months researching a single company, but in my experience, usually there's going to be one or maybe two burning questions that will determine how a business is likely to perform over the next 3 or 5 years. And identifying what those questions are is the real strength of a human analyst. So it takes some creativity to do that. You have to be able to boil down a pretty complex situation to the couple of things that matter most. So where technology and a more data-driven approach comes in, though, is in answering those questions. And it's often the case now that you can arrive at a better, higher conviction answer by incorporating technology. Before we dig into some examples, I want to just be clear, there's a lot to investing that can set you apart beyond just having an analytical edge. At Orbis, for us, I think that includes structural factors like private ownership and an aligned fee structure, which puts us in a good place to execute an investment philosophy that really is rooted in a behavioral edge by, for instance, allowing us to make longer term decisions than some of our peers. So it's not all analytical edge. It's not all about research. It's not all about investment decision making, but those are going to be the topics for my talk today. So I just didn't want to lose sight of the fact that this is one important thing among many for managers. So what I'm going to do is walk through 3 quick case studies, and I'll be using Orbis examples because that's what we know, but we fully recognize that we're not the only ones among fundamental managers with good ideas about incorporating this technology. I suspect this kind of work is probably more common than what we might appreciate, but I think that's another reason why it's worth understanding. So the first of the 3 examples is aimed squarely at what we just talked about. So using technology to answer a burning question that's been framed by an analyst in a high conviction way. So let's take Comcast. This is the US cable company. It derives about 2/3 of its earnings from its broadband business, essentially selling internet access. And the core of the investment thesis here is that Comcast can continue to grow its broadband cash flows nicely as they add subscribers and as consumers trade up their internet packages over time. Our Comcast analysts had a burning question to support that thesis, which was, how can they keep adding these broadband subscribers? For how long, at what rate, and so on. Answering that required pretty bespoke process that leveraged some internal expertise from our team of data scientists, and that's where the data came in. So let's start with what we do know, and that's Comcast service area shown in blue here. This map comes directly from the company. But to add subscribers, Comcast has to take market share. And this chart doesn't tell us anything about the competitive situation in those blue areas. And so in trying to understand what the growth opportunity is within those blue areas, it's a very hard problem to tackle without advanced research. So you might hear some anecdotes about Comcast service compared to others. You could ask experts, you could talk to the company, but you're not going to learn the answer with much conviction. So what we did to tackle this problem was to enlist our team of data scientists to source, clean, and analyze about 20 million rows of publicly available information. Now that data is reported by internet service providers like Comcast to the US Federal Communications Commission, or FCC. And our team essentially downloaded that database, scraped it, and started processing it. So no fancy machine learning algorithm required, just heavy lifting, scraping the websites and having the technical abilities to manipulate huge volume of data. And those aren't skills that a lot of stock pickers have. So for instance, consider the maximum number of rows that you can have in Excel is about 1 million. So we're talking about a data set that's 20 times bigger than what you can handle in Excel, which is the tool that most investment analysts are still spending most of their time in. So after digging through all that data, what did we find? Well, we made this pie chart, which it must be a little bit underwhelming here, but the insight drawn from this is critical. What we found was that in about 60% of the areas where Comcast offers broadband, the competing internet offerings were exclusively slower. So that lends us a lot of confidence that Comcast can continue to take market share as consumers seek out faster internet speeds. So without this data and without our team of data scientists to help us collect and analyze it, I don't think that there's a great way of answering this question rigorously. And without the analyst, we wouldn't even begin to know what question we should be trying to answer. And so in this case, it really illustrates that process in which they worked together that ultimately yielded a better answer than we otherwise might have. Okay, second example. This one's a slightly different flavor of question. Let's say we're looking at MGM Resorts during the COVID-19 crisis. So this is a casino, hotel, convention business, makes most of its profits in Las Vegas. It was obviously impacted by the restrictions on travel and entertainment during the COVID crisis, continuing now. So we were interested in the recovery opportunity with the stock, but the company has debt. And so how quickly traffic returned to the casinos was a very important issue, even for long-term investors, because the market started to question this company's ability to survive the crisis. So we wanted to monitor that risk along with others as closely as possible to try to help identify potentially a good point of entry for the stock. So the research question is then essentially, will things return to normal? And importantly, by when? Now, 10 years ago, you could have done this. And some people still do it this way. You can go and sit outside the casino and you can count people walking in and out. So not very scientific, but you could perhaps form a low conviction view of the trend. You could also, of course, ask the company how things are going, but it's rare to get the most honest or forthright picture about what's going on. But in today's world, fortunately, we all carry a GPS in our pocket, essentially, so we can be a little bit more scientific about the way that we analyze foot traffic. So in this instance, what we did was we bought data from a provider to help us answer this question. Now, this provider tracks the movement of about 30 million smartphones and maps it to 13 million different places of interest across the United States. And we can use this foot traffic in all kinds of situations. Think things like theme park attendance, restaurant traffic, that sort of thing. And in this instance, what we did was we worked alongside the vendor to track foot traffic in and around MGM's Las Vegas casinos. So you can see here on the slide how we geofenced those casinos and identified them on a map to track people moving in and out. That allowed us to monitor traffic across these casinos, and they account for most of MGM's profits, so it gives you a pretty good read on the company's cash flows. And you can see the traffic shown in the yellow line here drop all the way to 0 in March and April 2020. But more importantly, you can see how traffic spiked back up to nearly normal levels by the middle of this year. Now, it's obvious why that's useful, right? It lets us track those footfall trends accurately in near real time. Now, the reality is, none of us really knew how people were going to react into a global pandemic. So the human analyst is there to make the best judgment call they can on the stock overall. But having the data here helped our conviction even before the vaccines were available, when traffic had recovered to about half of normal around this time last year. So if you take a look at that July 2020 to late 2020 period, we had a good recovery there. And as I mentioned, this kind of thing matters even for long-term investors like us when you're looking at a casino operator during a global pandemic, and especially one with debt like MGM. So those two examples of quantitative shouldn't be surprising given the topic. But let's look at a slightly more qualitative case study, which is the last of our 3 examples in advanced research. Here, we can leverage artificial intelligence and machine learning, and I'm sorry about the buzzwords, to help us quantify what is inherently qualitative information and use that in the research process. And we do this using a technique called natural language processing, or NLP, to help extract that quantified signal from text. So this field sits somewhere in the intersection between linguistics and computer science. It essentially allows computers to read documents and try to make sense of them, spitting out all kinds of quantified data based on the text of those contents. So our third example brings to life one application of NLP, which was in assessing corporate culture at a company called Motorola Solutions, which is one of our holdings. Now, there's a growing body of research that shows just how much corporate culture matters for a company's performance and by extension stock prices. The culture is a fuzzy concept though, so gaining insight on it requires a bit of a creative approach. So to assess culture, in this example, we're using Glassdoor data. For anyone who's not familiar, Glassdoor is the website where employees and past employees can anonymously review companies. So we can look at those Glassdoor ratings directly. You can go to glassdoor.com right now. Please wait until the webinar is over. And that'll give you some sense for what employees think about a company. So this chart shows the actual ratings for Motorola over time. And there's about 3,000 reviews in the sample from early 2013. So this is a very simple overall rating out of 5, what an employee thinks of the company. So no NLP or any machine learning involved here. All we've done is we've scraped the website for the rating data over time. And if you go to glassdoor.com, you'll see exactly this data just for a shorter time period. That's an interesting starting point. And that initial result looks positive, right? The average is over 4 stars out of 5, which is pretty good, and it's trending up. But it is hard to know how much weight to really place on this data point. And one thing we've noticed is companies are starting to realize that prospective employees look at Glassdoor before interviewing. And so companies have started to even game their stores by encouraging employees to leave positive ratings. So it's hard to know how much weight to really place behind a data point like this. Now we can combat this or help boost our conviction in this a little bit by using NLP to look at the sentiment of written comments submitted alongside the scores to see whether that matches the ratings. So this chart in yellow shows you the sentiment score. And what we can see in this case is that sentiment score is even stronger than the rating. We're getting a stronger signal from that. So that suggests that we're really onto something. So Motorola seems to be changing for the better, at least from an employee's perspective. We can dig a little bit deeper even. So those ratings, or the rating and the sentiment score, are for the company overall. Now, I said we were interested in the company's corporate culture specifically, so we can look into that. Here in the green line, we are showing the company's sentiment score, so very similar, calculated in a very similar way to the yellow line, but for comments that relate to corporate culture specifically. And you can see we're getting very strong signal there as well. So in the case of Motorola, this helped us gain conviction that the company's corporate culture was not only healthy, but improving under the leadership of a CEO we respect. And that CEO, Greg Brown, had been making an effort to improve corporate culture at the company. For instance, they moved the company's headquarters from Chicago's suburbs to downtown in an effort to attract more young people. And it's those kinds of anecdotes that are interesting, but hard to know how much they matter unless you have the analysis to either back it up or disprove it. And this analysis helped us build that conviction that Motorola's culture is improving. Now, I should say, this is a softer factor. It's not going to be the reason to buy a stock, but it's an increasingly important piece of the mosaic that an analyst tries to put together about a company in the research process. So that was advanced research. What about what comes after you've done the research? And that's where the decision-making comes in. Do you buy that stock you've just researched, or do you pass and move on to the next one? What position size should it be? When is it time to sell? There's a host of decisions that need to be made to invest successfully. And that's the realm of decision analytics. And Like I said earlier, it's earlier stage, and almost all the tools we work with here are experimental. We do think it's promising, and I'm excited to share a little bit about you. So decision analytics is really about two main things. The first is helping our analysts and portfolio managers learn, improve, and ultimately make better investment decisions. And there are low-tech solutions to the question of how to get better. And stock pickers have different approaches to that. So as one example, here's a page from my own private investing journal, which I use to keep track of my own investment thinking and decisions. So this isn't the actual research, but rather notes regarding the investment decisions that follow. And the idea here was that I could use this to go back and compare what actually happened with what I expected in an effort to understand, what went wrong and why. And I also used it to try to keep myself honest by being aware of the cognitive biases that could be affecting me in real time. And in the bottom left, any eagle-eyed viewers will spot me asking myself whether I'm exhibiting anchoring bias after discussing Nike with a Forbes journalist after feeling a little bit nervous about its valuation. So I thought this was a good system, and it's certainly better than nothing. But from my experience, it was far from perfect. So I struggled to keep it up to date. I struggled to keep it complete. It's a very big time investment. And frankly, it's just hard to be objective about the biases that affect our own thinking. So that was the first part. How decision analytics can help me learn and improve more systematically than my low-tech approach. The second part here is really about helping managers to tease out skill from luck to ensure you can reward and promote people a little bit more objectively than you could just by looking at results. Now, this is a particularly sticky problem because investment results are very noisy, and investing, I think, as much as the industry hates to admit it, involves a healthy dose of luck. And this spectrum is from Michael Morbison's book, The Success Equation, which is highly recommended. And in it, he shows a few ways to quantify, at least roughly, the role of luck in various sports as well as investing. And you can see here where he placed investing, which is pretty close to the pure luck end of the spectrum, while chess, on the other hand, is pretty much pure skill on the other side of the spectrum. Now, amongst sports, the difference here is mostly explained by the number of opportunities the team has to score in a given game. So in basketball, for instance, this is the one that's closest to pure skill here, outside of chess. Each team has about 90 opportunities to score in a game. And since there's so many opportunities for skill to shine through, the role of luck tends to be smaller than it is in other sports where you score less in a given game. Another factor here is the link between cause and effect. So if there's a very clear, direct link between cause and effect, then luck tends to play a small role. And to bring that back to investing, most fundamental strategies, certainly long-term ones like ours, make relatively few decisions each year. And you can make that same decision 100 times with wildly different results, depending on what the environment's doing around you. And so the role of luck in investing is big, and it can take many years for skill to stand apart from luck. In fact, it can take a really, really long time, not just years. So here's an example, some research from the London Mathematical Lab. And this shows that if an analyst outperforms the market by 1,000 basis points a year, 10 percentage points, like Warren Buffett, next Warren Buffett, it would still take you 12 years to know with certainty, 95% confidence, that that investor is exhibiting skill and not luck. So and if you take that down a little bit, so at 500 basis points of outperformance, it would take you around 50 years. So I think it's fair to say we can't afford to wait that long as an industry to assess our managers or to assess our people. So it's important that we collect as much data on their decision-making as possible, even if there's just no way to reach a chess-like assessment of skill. Now, what's interesting is when we talk with our clients and our consultants about our investment professionals, the questions are more often framed around compensation and alignment. And rightfully so, those are very important. But so is the way we actually go about assessing our people, and doing our best to try to separate skill from luck and helping them develop. And that work certainly gets a lot less attention which is why we wanted to share a little bit of a perspective on the topic with you today. Now, I'll get to some specific examples of decision analytics in action in a second, just like we did with the advanced research piece. But I wanted to just take a very quick detour to talk about infrastructure. And that's because if you don't have the right technology infrastructure in place, you can't capture the data you need to extract insights about the quality of decision making. So in the ideal world, what does that look like? Great infrastructure to support decision analytics would track and break down every investment decision you make as an individual. And many managers do collect the basic data points, like who recommended what stocks and when. And we do the same. This is a screenshot from our system. And to be clear, I'm not trying to be promotional. We're not the only ones doing this. And our system's far from perfect. You can tell, this looks like it's straight out of the 90s. And please resist the temptation to try to read everything here. I just thought a snapshot might help bring it to life. But with the system, we capture analyst recommendations. And we try to go a little bit further. So our analysts each manage a model portfolio of 5 to 10 stocks that simulates real market conditions. So for instance, our analysts are subject to things like impact costs and accumulation rates and so on. And we've done this for every analyst that's worked at Orbis for nearly 30 years now. It gives us a pretty good foundational framework with data points in place, things like win rate, capital invested behind winners, and so on, that we can extract from this. But what we're trying to do with decision analytics is to take that to the next level and to extract deeper insights about investment decision making. And I've got a couple of examples to show you how we're implementing it. They're all intended to help stock pickers make better decisions, but also in time could become useful inputs to help evaluate and reward our people. And let's start with something a little bit simpler, just the types of things we can do using just stock prices and forecasts of stock prices. One enemy to good decision making is cognitive biases. Here's our friend Charlie again. And we can use tools to mitigate, although never completely eliminate, the behavioral biases as part of the decision-making process for stock pickers. And managers can use the same tools to monitor for biases in their analysts and in the investment process. Now, nothing I'm about to cover solves the underlying problem of having cognitive biases. It's just about raising awareness, which we think is the most important step. So for this example, let's say I start researching Disney. And I roll up my sleeves. I spent weeks and months digging deep into the company. I might even use some of the data and techniques that we just described in advanced research to help develop support for my investment case. Now, I go to our system to enter my forecast. And this just shows a spectrum of expected return over the next 4 years from left to right. And let's say I've concluded that the stock offers a 25% annualized return over the next 4 years. And as I do this, what kind of cognitive biases could be affecting me? Most commonly in this situation, I might be overly optimistic. And I might be overly confident in my ability to forecast what the next 4 years actually looks like. And maybe even worse, because I'm overly confident in my own abilities, I'm probably not inclined to look for disconfirming evidence. So as Daniel Kahneman, the Nobel Prize winning psychologist, puts it, people with knowledge about a specific situation, so me researching Disney in this case, he calls that the inside view, usually ignore valuable information about other similar situations, which is what he calls the outside view. Now we can combat that bias by raising awareness of what that outside view actually looks like. And a simple way to do that is to show what the base rates historically have looked like when I enter my forecast. So here's the distribution of 4-year returns for Disney historically. And you can see here the most likely return is about 10%, and returns above 15% become increasingly rare. So now you overlay that 25% forecast and realize, geez, that would be a bit of an outlier. And that raises the question for me as the analyst, does that fit with my investment thesis? Do I really expect the next few years to be some of the best for Disney stock? And seeing this distribution may or may not change my behavior, but I think it would prompt me to reconsider my expectations. And doing this doesn't require any special data, just the system that systematically records your forecasts and shows you historical returns as you make your inputs. Now, how can we use this to learn from past decisions? So let's say all that happened a few years ago and I've updated my Disney forecast a couple of times, and here's where those forecasts fell in the dotted orange lines. Now, I can start to look at these and assess my own accuracy, right? This example uses a single stock, but I can also zoom out and say, across all my stocks, can I start to spot where I'm making mistakes and ask myself, in what kinds of situations am I overconfident? Am I structurally too bullish or too bearish? Do I appreciate just how unpredictable the future really is? So the shape of that distribution. And I can try to keep all of that top of mind as I enter my next forecast. But perhaps even more powerfully, Orbis can integrate the tool in my workflow to try to give me personalized nudges based on my past biases, helping to dial in my expectations a little bit better next time around. And I'll get back to nudges in another example. So that was kind of stylistic, but here's an image from an actual tool available to our analysts at Orbis. So on the x-axis here, we are showing the error in the analyst's forecast. So not the absolute forecast, but the difference between the analyst forecast and the actual outcome. So a number bigger than 0 means that the analyst forecast was too high. And the blue distribution is a specific analyst, and the orange distribution is all Orbis analysts combined. So this shows, if you just focus on that orange distribution for a second, that Orbis analysts tend to be overly optimistic. That's not a surprise, though, because only the stocks that we're actually interested in have forecasts in the system. And we have to recognize that even world-class investors could be wrong 40% of the time. So the bigger insight to draw from this is for the analyst in the blue distribution. So they're still wrong a lot, they're still overly optimistic, but less so than the average analyst at Orbis, which is constructed for them. So that tool puts that analyst in a position where they can figure out how accurate their forecasts are, which direction they might want to tilt future forecasts, and to compare themselves across teams. As a side note, we can also use this information to see an analyst's progress over time. So what this does is it's showing those same distributions, but sort of from vintage years 2014 to 17. So for forecasts made in 2014, 15, 16, and 17. And you can see that this analyst dialed in their forecasts over time to become much more accurate as that vertical blue line, the average line, moves towards 0, an encouraging sign for their development and perhaps a good signal for themselves that they're on the right track. So those examples use very simple inputs, basically just historical and forecast stock prices, that's it. But as we touched on already, stock prices contain so much noise that they can be misleading, both as something to learn from and as a way to evaluate people. And so stock pickers run the risk of drawing the wrong lessons from winners and losers, and managers run the risk of not promoting the right people. So to help address this, what we'd like to do is go deeper than just stock prices and investigate how the fundamental case for a stock played out relative to an analyst's expectations at the time of the decision. So we're currently implementing a system that allows analysts to capture the individual fundamental thesis points that support an investment case. So this allows them to measure themselves against reality as it unfolds, and it allows Orbis to assess their strengths and weaknesses a little better. So this screenshot from our tool, we're using Apple as a dummy example. And this investment thesis has the 3 components. The first is capital allocation, second is margin expansion, the third is COVID recovery. And behind each of those would be a couple of paragraphs summarizing the investment thesis. But more importantly, for each of these thesis points, we capture conviction, which we compute as a function of the analyst's confidence in that thesis playing out as expected, and impact, meaning how important that thesis is as a driver for the company's stock price. And we track that conviction over time, and the trend is shown here in this table as well. Now, this is all captured in addition to what you might expect, the basics like the forward return expectation for the stock, earnings per share forecasts, and so on. So what's the use case for this tool once we've captured this? It's still experimental, but we've got a couple of things in place. One is as a way to offer our analysts nudges where they might be useful. I promised I'd get back to nudges. But for example, here is a speech bubble that pops up when an analyst has cut their earnings forecast for a high conviction stock repeatedly. So it's prompting that analyst to reconsider whether it's truly a high conviction position given the earnings trajectory. And this kind of thing just isn't possible with price forecasts and research reports. You need somewhat more structured data about your investment theses to make this work. Here's another example of how we leverage a thesis tool, breaking down a portfolio of stocks by alpha contribution and the extent to which that thesis has played out fundamentally. And just to be clear, this is a dummy example, not intended to be predictive of future performance for these stocks. A quick disclaimer. So this breakdown lets us ask the right questions and nudge analysts in the right direction. For example, in the top right, you've got stocks that have done well and where the fundamental thesis is played out. For those, you might ask, is it time to consider trimming or selling? In the top left are high alpha stocks where the thesis didn't play out. Useful prompt there, what positive fundamental drivers of the stock might you be missing? The bottom left, the thesis didn't play out and the stock performed poorly. Is it time to cut your losses? And bottom right are stocks that performed badly despite the thesis playing out as expected. So there we're asking, could you be missing any negative forces that are weighing on the stock that haven't been captured? So stepping back, you'll notice across these examples a theme around nudging stock pickers in the right direction. Part of what we're trying to do is working on a framework for these nudges to allow analysts to use them throughout our systems, but in a way that is most useful to them. So that could range from saying, I don't want nudges and turning them off completely, to saying I would like gentle nudges in extreme situations, or to saying I want more persistent nudges more often. And we think that's important because our stock pickers should be in the driver's seat at all times. And some of these things, if applied to every person, could backfire for some analysts. So why do we think all those tools are useful? Our view is with decision analytics, we can extract much more insight about the quality of decision making than just looking at plain vanilla stock returns. And while the main use case for those insights is to help our stock pickers make better investment decisions, we think it opens up opportunities to help reward and promote people who show promise, not judged by whether they were right about a stock, but whether they were right for the right reasons. So those are just a handful of examples that we think are some innovative ways to incorporate technology to help develop people. But we would love to hear anything you've seen in this exciting area in questions or comments. And I promise we're almost done. So that was the decision analytics piece. Thanks for sticking with us. A couple of concluding thoughts before we open up for discussion. So, I hope to leave you with a sense of optimism. I think everything we've talked about today is good news for stock pickers. It's good news for managers. It's got us excited. Technological change is always a little threatening, but we think that freestyle chess analogy holds true, that we can invest better by incorporating technology. And so we shouldn't shy away from doing so, even for long-term fundamental investors like Orbis. And we think about doing that in two areas. The first is conducting more in-depth high conviction research. And the second is studying our decision-making to assess our people and help them improve. And importantly, just like in freestyle chess, you still need a solid process that brings together the best of human decision makers and data-driven inputs for optimal performance. And I just add, again, maybe one final time, we're not the only ones doing interesting stuff here. I'd love to hear from you in the Q&A about what you've seen. But what we're more confident in is that this topic isn't getting the attention it deserves and can be explored much more deeply, especially when it relates to managers like us that focus on the fundamentals and that don't come with that quant label on the box. So, hopefully this presentation has highlighted some of the areas to explore. If you're a manager, explore that with your teams. If you're an allocator, explore some of these areas with your managers. And I thought the last thing could be useful. I know we've got a broad audience. Not all of this will be necessarily interesting to you, but just a couple of pointers. I think allocators use these as a way to push your managers, ask them these questions. Managers use this internally. The first is to ensure you review those burning questions that you have for each of your stocks, and then identify whatever new sources of insight are available that could help you answer those questions with more conviction. The second is to ensure your analysts have the support they need to do big data analysis effectively. And that could mean employing a team of data scientists to help them. We're seeing more and more managers do that. Third, capture that more structured data about the fundamental underpins, so the drivers of the stock of an investment thesis, not just the research report. Capture it in a more structured way and make sure you capture each of those individual thesis points. Fourth, try to create some awareness of behavioral biases throughout your entire investment process in whatever ways you can. And lastly, use whatever data you have available to help you tease out skill from luck and evaluating your people. Don't focus just on the stock prices and alpha. So with that, I'd like to thank you again, and I'll hand you back over to Chris. Thanks for your patience with us.
Thanks very much, Eric. Always interesting to hear from you on this topic, and I certainly hope our audience today enjoyed the presentation. As Eric mentioned, we really do think this will be an area of increased focus for the industry in the years to come, particularly the space of decision analytics. So hopefully Eric was able to leave each of you with at least one insight that you can apply in your work moving forward. We'd now like to open it up to questions, and we have received a few, so thank you very much. Please have those, please continue to submit those. I also have a couple questions which may prompt some discussion, and maybe I'll start with one, Eric, and then I'll move to one from the audience. You've obviously shared a lot of kind of Orbis's perspective on this topic, leveraging very specific examples of the work we're doing. But in your best assessment, how commonplace are these systems technologies you just described? Should clients expect all fundamental managers to, at a minimum, be deploying advanced research technologies? Should every asset manager have data scientists on staff, be leveraging AI, machine learning? What thoughts can you share there?
So I would say at the highest level, advanced research, I would guess almost every manager, however small, is applying advanced research in some way. The distinction to make there is what is being bought off the shelf from third-party providers. So kind of like that MGM example, where we worked with the provider very closely to geofence those casinos and assess that traffic. That's a little bit more, that data is not collected by us. It's going to be less unique and less differentiated. So try to distinguish between that and what the manager is doing themselves. So I think, it's more common for managers now, especially larger ones, to employ their own data scientists to scrape their own data and to do analysis on their own data. It's going to tend to be more differentiated, more interesting, but perhaps most importantly, more targeted to the very specific question that manager is trying to answer with that investment thesis. Right? So I would try to tease that out within advanced research. Decision analytics is very new. I would love to hear from others what you have seen, but it's fairly new for us. And we have, I think, pretty good sort of technological infrastructure in place, meaning like the data on decision-making over time to experiment with. And even for us, this is pretty new. So it's possible that we're behind the curve, in which case, we want to know and tell us. But I'd suspect that that's newer. I think the cool thing about it, though, is there's so much you can do just with stock prices and forecasts. And that's why I try to show that in the first examples, that you can get value from that without needing 30 years of history in your data. So if I were going to push managers on that, I'd ask them what they're doing, specifically targeted around behavioral biases.
Great, thanks. And I mean, that's useful in terms of at least giving your best assessment of what's happening in the industry broadly. Obviously, it's hard to speak beyond what we're doing as a firm.
Yeah.
This is a question that kind of builds on that, and it comes from the audience. Mm-hmm. For a more traditional investor that perhaps doesn't have the coding background required to do some of this big data analysis, how do you suggest bridging the gap between advanced quantitative strategies and the more traditional fundamental work?
Yeah, that's a great question. So I think one way around this, it depends on one's resources, but if one has an opportunity to work with third-party providers that's possible. And I think the better your relationship is with them, the more tailored the work can be based on what you're trying to answer. And so to me, the first thing that comes to mind is get the off-the-shelf data, build relationships with those data providers, and start pressing them for more tailored work. And they can do that on your behalf. I think that's a great option. One thing that is happening is the quality of tools available from third-party providers is improving quite dramatically. So what you're getting is not just a PDF, with updated charts every month or every week. Some of them are now giving you access to their platforms to allow you to do at least some basic data manipulation in a way that doesn't require any kind of coding backgrounds. I've worked with some of those. So it is getting easier and easier, at least for the data that you can buy off the shelf, and that's growing every year. So I'd say you probably have access to quite a bit just by sticking with what's available from third parties and making sure you leverage the tools that they're making available.
And so this is another question along similar lines. I don't know if you know all the pricing details for some of those third-party resources, but this is a question from the perspective of an individual investor who may not have the resources of a large investment firm. Any tips you'd suggest there? I mean, obviously, Glassdoor data, which you spoke about, is publicly available, free. Yep. Any other perspective you could offer for an individual investor trying to apply some of these same techniques?
Yeah, so I think for quite a few of the data sets that I've worked with, there are free alternatives that you won't reach the same level of conviction you would by having a bigger data set, but you can directionally get to the same answer by looking at free sources. I think Glassdoor is a great example because all we're doing is scraping that data. And we're then doing some interesting analysis on it, but you get a lot of the way there by just looking at the data that's available on the website. It's just that lots of folks still aren't paying attention. And beyond that, I mean, part of what I illustrated on decision analytics purely involves stock prices, right? And your own expectations for what the future might look like. So to do that kind of, let's say, take that distribution example, to create a distribution of historical returns for a stock is not that hard. It can be done in Excel, and all you need is stock price data, which you can get from a lot of different sources. So in terms of fighting bias, I think there's actually quite a bit that can be done just with price data. I try to illustrate some of those. On the research side, stick to the free sources, and you're probably still kind of ahead of the crowd just by paying attention.
Moving on to another question from the audience, and this speaks to some of that data and research you shared from the London Mathematical Lab, suggesting just how long it can take to gain a high level of conviction in discerning skill from luck if you look purely at returns. Yeah. So the question is, if it takes 300 years to be 95% confident that a manager or analyst can add alpha of 2% or higher, I'm not sure exactly that's what the data shows, but I think you take the
directionally right.
Yeah, you understand what the
I can't
question
remember the
is
table
asking.
exactly, but it's directionally right for sure.
This is obviously multiple lifetimes. Does this imply that picking active managers is mostly based on luck? And maybe this goes to some of the points you alluded to earlier, just how important it is to look holistically at some of those other aspects when assessing a manager to really understand edge. But I'll let you comment.
Yeah, there is luck involved for sure, and it can be hard to separate luck from skill. I think the job of an allocator and assessing managers is very hard, maybe more so than picking stocks. I think picking stocks is pretty hard. I think assessing managers is very, very hard. I do think you can gain a lot more insight in skill versus luck by looking deeper than just alpha. So that, of course, is the most simplistic indicator we can look at. It's the thing that people care about, and rightfully so. Right? We're oriented around performance fees. It's all about our alpha, and that is the outcome, but it is the outcome of a process. And you can look beyond the outcome to see into the process to help build some conviction. You're never going to get to full certainty, but more conviction that there could be skill involved and not just luck. So there's a lot more to look at. So I would say there's always going to be luck involved. There's no way to reach 100% certainty, but geez, there's a lot we can look at than just alpha. And that's, of course, when we meet with clients, that's mostly what we spend time on. They know the numbers, but they're looking deeper into our process, into our philosophy, into our people. And so it feels to me like spending time on those areas can give you a much stronger sense, but it's a tough job.
Yeah. In much the same way that it's a tough job to assess analysts, maybe building on this topic, building on that same data from the London Mathematical Lab. How useful understanding those limitations, and you've already kind of addressed this a bit in the presentation, but how useful do you think the decision analytics data that managers are starting to collect or exploring can be in helping to more accurately or objectively assess skill within investment management?
I think it could be very useful, depending on the manager. So, for instance, if you have a single manager portfolio, that's kind of the simplest example. The data for that decision maker is going to look pretty much the same as the data for the portfolio as a whole. So, to the extent one can access data like that, I think can be very valuable in teasing that out. It's almost a direct one-to-one application of much the same idea. I think the risk, though, is that we try to go a little bit too far down that skill luck spectrum and treat investment management as though it is science, when we all know it's an art, because the environment around us is changing constantly. So the strategy that Ben Graham applied very successfully for a long time and wrote about in a very influential book, it's been brutal for that strategy over the last 12, 13 years. So the environment around us is changing all the time. So you don't want to be too rooted in what's happened in the past. And I think that's the big risk with all of this, is that we try to go too far. So we're trying to keep ourselves grounded, recognize the limits of how far we can go. But I still think it's useful, and I still think we can nudge evaluation a little bit more in the skill or science direction than where it is today.
And maybe one last question, just understanding that we are very close to time. You've alluded to some of the concerns that you would have when it comes to decision analytics, maybe going too far, placing too much emphasis on it. As someone who's spent a long time investing, a long time picking stocks, what has you most excited when it comes to decision analytics and that space, maybe focused more on the ability to improve as a stock picker rather than focus on that assessment aspect?
I think it's the nudge framework for sure, because that premise, the ability to nudge analysts in the right direction, it comes in where an analyst is trying to do something that suggests something that looks quite different from the historical base rate or the Kahneman outside view. And I think creating even a small amount of friction in those situations that causes an analyst to perhaps rethink something, if the analyst has signed up for that and they're on board with that idea, they understand how it works, is extremely powerful. Because I think the single biggest thing holding back humans from making better investment decisions is cognitive bias. I think whatever you can do there is going to have a big impact. And so I'm very excited about this premise, the idea of nudges, and how that's being implemented at Orbis.
Right. And again, obviously nothing that's going to eliminate those biases, but making or increasing awareness or possibly helping to mitigate them as best as possible.
Yeah. I think if you take what I see as like the biggest blocker to making better decisions, and you reduce that blocker by 1 or 5 or 10% in size, I think that has a meaningful impact on the quality of decisions.
Great. Well, thank you again, Eric, and thank you all for joining us today and for submitting questions. I'll pass it over to Sid to wrap up. Oh, and I would just indicate, please, I think our contact details will be made available, but please feel free to reach out to either Eric or myself if you have additional questions that we didn't have the chance to address here this afternoon.
That's great. Thanks so much, Chris and Eric. I just wanted to thank you again for this great presentation today, and also wanted to thank everyone else who's attended and the questions and participation. This is our last webinar of the year, so just on behalf of the CFA Society Ottawa, I wanted to thank everyone who attended this and our various other events over the course of this pretty challenging year. We do have some great events coming up in 2022 as well. including our third annual lifestyle event. The registration is now open for that one, so we're very much looking forward to seeing you all there. With that said, thanks again to Chris and Eric. Thanks to everyone who attended, and wishing you all the best heading into the holidays. Thanks, guys.
Thanks, Sid.
Thank you,
everyone.
Sid.
Appreciate it.
Thanks, everyone.